Now it's time to talk about these different types of loans. And again, it's going to seem like quite a few of them, and there are. But I think you'll find most of these loans, quite frankly, if not all of them, you've heard of before, or at least familiar with. But in some cases, you may not be familiar with their legal name. Because sometimes we've got a name we're accustomed to calling certain types of loans when they may have a different legal name. But anyway, we'll get into some of that as we go through. So, we start out with this straight term mortgage. Straight term. All that is an interest-only loan. That's all it is. So obviously, when you get this loan, if you borrow $20,000 straight term mortgage, as you're making your payments, you're only paying back the interest you owe on that $20,000. You're not paying down any principal. It's just an interest-only loan. Be careful with these, quite frankly, but they can be very useful, and if used the right way and for the right reason. But obviously, if I take out $20,000 straight term mortgage, after you've made all your payments, how much do you still owe? Well, $20,000. Again, no principal is going towards, or you're not paying any principal towards paying it off. It's just all interest only loan. Obviously, these might be useful for like short-term purposes. But then we look at this fully amortized mortgage, and where you want to be careful here. We're going to look at what is a fully amortized, and then we're going to look at a partially amortized. They're very similar, but some pretty significant differences too. So you want to make sure you keep these straight. But if it's a fully amortized mortgage, and by the way, what they're talking about here when we say amortize, if we amortize the loan for say 30 years, I mean you want to pay the loan off in 30 years, then that's a fully amortized loan. They will calculate the payment, what you'd have to pay every month for 30 years. That includes both principal and interest. Okay? So you're paying, you're paying it all off as you go. But your last payment will be roughly about the same as your first. Okay? The last one obviously might be a little bit different, a little higher, a little lower. But it's typically about the same as your first. You make the same payment every month for however long you amortized it for, 30 years, 40 years, 20 years. That will pay the loan off in full. You owe nothing at that point. That's fully amortized. But then when it comes to partially amortized, here's what you got to really kind of be careful with. This is also, you amortize it for a certain number of years, say 20 years. And each payment you make includes both principal and interest. So you are paying the interest you owe, and you're paying some principal to pay off some of the loan amount. But here's where the problem comes in with partially amortized. Even though it's amortized for 20 years, and if you made that payment every month for 20 years, then obviously that pay it off. Problem is you're not going to get 20 years to pay it off. They may say you have to pay it off in, say, 5 years, or 6 years, or 7 years. Depends on your loan. But there'll be a maturity date. Say it's 5 years after you get the loan. That means, yes, you've now made 5 years worth of payments, but you still have 15 more years worth of a loan balance that you still have to pay off, right? Well, all that has to be paid all in one lump sum. Whatever the remaining balance is at the end of that, say, 5-year period, you got to pay the remaining balance off in one lump sum, or sometimes you hear it called a balloon payment. And I promise you, boy, that last payment is going to be a doozy. That one will get your attention. So why would one do partially amortized over, say, a fully amortized? Well, it depends on what you're using it for. What's the purpose? If you're getting a residential loan, you're probably going to be getting a fully amortized loan. But if you're getting a commercial loan, that's probably going to be partially amortized. It's just the way they do it. One's for residential, the other one's primarily for commercial. All right, so there's your fully versus partially. Then we look at this adjustable rate mortgage, or ARM. You hear it called a lot, and I assume you're probably familiar with it. But the big deal about this loan is the interest rate. Typically with this loan, the interest rate you get, at least initially, is typically a good bit lower, a lot less than what it would be for any other loan. That's kind of what they use to kind of draw you into this loan. The interest rate will be a lot less than other typical loans. But the other problem with this loan is, you notice it says it's an adjustable rate. So even though you kind of get lured in with a lower rate, you're only going to have that rate. And now it will be fixed initially and for a short period of time. Y'all say short period. It could be relative to what you're trying to do here, but it could be just like 3, 4, 5 years, something like that. Again, it varies on what that would be, so make sure you know what you're doing if you decide to get one of these loans. But let's say again it was a 5-year maturity date. Well, after that maturity date, then your interest rate will now begin to adjust. It will now go up or potentially down to whatever the current market rate is. Excuse me. Here, where people have had a lot of problems with this, typically they're borrowing as much money as they can possibly borrow with that lower interest rate. This is the most they can pay. That's the most payment they can afford to make, which is why they decided to go with this loan. Because the interest rate is a little bit lower, where now they can afford whatever the payment is. But what are you going to do 3, 4, 5 years from now when it adjusts? For example, say you initially got it at a 5% interest rate, but the rates today are at 7%. So all of a sudden your interest rate's going to jump from 5% to 7%. That could, in essence, make your payments double or triple whatever it was. And the problem is, it was all you could afford to pay at the lower rate, and now it's gone up. Now you got a problem. But that's the risk with when you get an adjustable rate mortgage. Now, obviously, if you plan to have this for a short term, just a couple of years or 3 years or something like that, might not be a bad idea. But this is probably not a very good loan for a long-term situation, like buying a house. If you think it's going to take you anywhere near 20 or 30 years to pay it off, you probably don't want to get an adjustable rate mortgage. That would be extremely risky. But there you go. Then here's the conventional mortgage loan. We've already talked a lot about this one already, but with a conventional loan, remember the loan to value is 80%. So the lender will loan you 80% of the purchase price. Or if they agree to loan you more than 80%, remember, then you must also pay the private mortgage insurance, PMI, and you have to continue paying for that mortgage insurance until you can show you have at least 20% equity in the property, right? Once you can show or prove you have 20% equity, then you can ask the lender to drop the mortgage insurance, and that'll save you some money there. But if you forget or are not thinking about it, and you don't ask the lender to drop it, even though you have 20% equity, once you get 22% equity, now the lender has to drop it. So, just make sure you remember the 20% and 22% in terms of the equity. All right. The next loan is the reverse annuity mortgage, or a RAM. You hear it referred to a lot. About the best thing I can tell you about this loan, if you decide at some point to ever take one of these out, just prepare to get the RAM. That's all I can tell you. Obviously, I do not like these loans. I know a lot of people do. A lot of lenders I know, they love them. But I'm afraid they love them for a different reason. Primarily because, loan officers make a lot of money off of these loans. This is the one, you see them being pushed a lot. You see them on TV commercials a lot. This loan makes a lot of money for the loan officer, the loan originator and whatnot. But not suggesting that's why they like them so much, but just saying. I don't like these loans. I just don't like them. First of all, they're geared towards the elderly. And I say geared towards, in fact, I would even go as far, in my opinion, I think it's almost like preying on the elderly. I really do. I don't like these loans. If you like it, that's fine. Get it, and I hope you're happy with it. But obviously, you have to be 62 years of age or older to even apply for one of these loans. So, that's one reason I say they're kind of going after the elderly, because, you got to be elderly to get one of these loans. They won't allow someone under 62 to get one of these loans. But what you used to hear a lot, and still do to some degree today, even though they've tried to change some of this verbiage they were once using. But at one time, they would tell you, this is a loan where basically we will loan you the money and you never have to pay it back. Who in the world would believe such stuff as that? Then if you're saying I never have to pay it back, then why are you calling it a loan? Why don't you just call it a gift and give it to me? Because it's not true. It's just not true at all. But now they've kind of revamped that verbiage a little bit. And now they kind of say, this is money we will loan you. And you don't have to pay it back as long as you live in this house. Now, there is some truth to that, but there's some things they're just not disclosing how this loan works. And this is what really bothers me about it. And there's no requirement to disclose all the details to this loan. They're happy to tell you all the good things and why you need it. And it's going to sound good. It's just they're not telling you all the nuts and bolts that go into it. They're not telling you about that because there's no legal requirement to do so. But anyway, but here basically what they're doing is this. The money they are agreeing to loan you under this type of mortgage is, it's your money anyway. It's the equity out of your home. So assume you have equity in your home. They will loan you your money. Isn't that nice? That's yours. You own that. But the bank's willing to say, but we'll be nice enough to loan you your money. Anyway, and you don't have to pay it back. Now you can't. You can make payments to pay it off, but you don't have to. As long as you live in the house. And here's where the problem kind of comes into play. First of all, these are just very expensive loans. There's a lot of expense on the front end just to establish the loan. Then, every month there are other fees that are associated with the loan that even though you're not writing a check for it, they're taking it out of your equity. So it won't take long and you're going to blow through every penny of equity in your home. And now once it's gone, once the equity runs out, then that's it. You ain't getting no more money. But do you now have to pay back what they've already lent lent you. And y'all, not as long as you live in the home. But what happens when you get elderly, and you can't live at home alone? Maybe you have to move into an assisted living, or maybe you move in with one of your children or whatever. Y'all, now that money has to be paid back. Well, typically there's a reason you haven't paid it back already, and that's because you don't have the money. Now what are you going to do? Well, no problem. Y'all, and by the way, this is a government loan, which in itself is kind of scary what the government's doing here. But in essence, y'all, the government's going to wind up with this house. Unless you or somebody, a family member, whatever, can come in and pay off that debt that you just accumulated with this thing, y'all, the government's going to take the house. And here's what kind of gets me. And y'all, if some of this has changed over the last few years, then y'all can check it out for yourself. But this is my understanding. Y'all, they will only loan you up to 80% of the value of the property. Y'all, assuming you have that much equity, okay? But they're going to require you to keep 20% equity in the house. They're not going to let you take out more than that. You got to keep at least 20% equity in the house. So you got to have a good bit of equity in the house to start with to do one of these loans. But so when the government, if they have to take the house, they now own the house with a minimum of 20% equity still in that house. And the government is taking it for themselves. Y'all, that to me, I don't like it. It doesn't sound good. Y'all, I'm sure there are people out there that have gotten a RAM and will tell you they love it, which is awesome for them. But I don't think I've ever talked to anybody that ever got one and was glad they had it. In fact, I've had many people call me up and say, Frankie, how do I get rid of it? Y'all, it's almost impossible to get rid of it. Again, the only way to get rid of it, you got to pay it off. Well, if they had the money to pay it off, they probably wouldn't have needed to take out that loan to start with, right? So, y'all, it's just I don't like this loan. But anyway, what do I need to know for test purposes concerning the RAM? Well, one is for seniors, y'all, 62 or older. In fact, the way they'll try to word a question, or will word a question on the exam, y'all, it will make mention in the question that you have, say, an elderly couple, senior citizen living in the property or whatever. Y'all, there's your clue right there. Y'all, as soon as they say elderly, senior citizen, y'all, anything to suggest this is an older person that needs money to do this, or whatever, y'all, which of the following might be the best loan for them? Y'all, the answer they're looking for is this reverse annuity mortgage. Y'all, this is strictly for the elderly. So that's the term, that's the verbiage I'd be looking for in the question. Y'all, as soon as it said anything about elderly or senior citizens, I don't even need to read any further. That's a RAM. I guarantee you that's the answer they're looking for. All right, so there's your reverse annuity. Y'all, the next loan is what we call an open-end mortgage. And the way this works, basically you would get pre-approved up to some amount. Y'all, say for example, $40,000. You're approved up to $40,000. And if you want the whole $40,000, they'll loan you the whole $40,000, but you don't have to accept all of it. It's basically a line of credit. So you can make draws. You might say, well, I just need $15,000 right now for whatever reason. So you just pull out the $15,000. Well, you still got $25,000 left, right? Y'all, you got a $40,000, basically a line of credit. And as you pay that off, y'all, you can pull it back out and use it again. Y'all, it's like money, right? So, y'all, what does that sound like to you? A home equity line of credit. Y'all, it's a HELOC. Y'all, it's a home equity line of credit. It's just the legal term for a home equity loan is an open-end mortgage. Y'all, that's all that is right there. So if you ever get a home equity line of credit, y'all, that's considered an open-end mortgage. That's it. All right. Now, I will tell you, and I don't know this is a big deal necessarily for test purposes. Just know what I just told you for test purposes. But y'all, if you get an equity line of credit, y'all, typically these are interest-only loans. So you're making payments on whatever you draw out, but you're only paying the interest. So you'd have to pay whatever the minimum payment is, which is the interest every month, plus some other, some amount of principal. Now look, you don't have to pay principal, but you're going to be paying that interest an awful long time if you're not paying down what you owe at the same time. Okay, moving on. Y'all, then we see these subprime loans. And I don't know about you, but that don't sound good to me right off the bat. A subprime loan. And it's not good. Y'all, basically, these are loans made to individuals that cannot qualify for a conforming loan. Y'all, the conforming loan means you get the best deals, the best rates, because you got a good credit score. Your debt to income is not out of line. You got a job. All these things are positive, so you qualify for a normal or a conforming loan. They conform to FHA guidelines and whatnot. But anyway, or Fannie Mae guidelines. But the subprime loans basically these are loans made to people that quite frankly should not be getting a loan. There's a reason your credit score is not good. There's a reason your debt income is already, you owe way more than you owe already, but yeah, we're going to loan you some more money. Y'all, this is insanity all by itself. But y'all, they basically, the way they structure these loans, they make it almost impossible to pay it back, because y'all, you're going to have to pay a much higher interest rate. Y'all, the fees are astronomical. Y'all, this is just an extremely expensive loan. And what I've asked lenders this, not that I would ever get one, nor would I want one, but if you're concerned because of my debt to income or credit score or whatever, if you're concerned that I might not be able to pay the loan back conforming, say with a 6% interest rate, what makes you feel so good I'm going to be able to pay it back at 9% or 10%? Y'all, that's insanity. In fact, I don't think they have any intentions on you paying it back. I think they want you to default and they're going to take whatever collateral they can get out of it. But anyway, y'all, that's a subprime loan. Typically not a good idea. This next one is a wraparound mortgage. Now, this is a very interesting loan here, but y'all, there's a good bit that goes into this as well. So we need to talk about this a little bit. In fact, I think probably the best way to explain it is just to give you an example. I haven't had a lot of clients use this type of loan, but I can recall one in particular, so I'm going to use them as an example. But I had clients moving from out of town. They were in the county next door to where I am, but they were leaving that county, moving to county I'm working in, and wanted me to help them find a house here where I am. The problem is, they still had their house in the neighboring county. It was for sale. They had it on the market. It just hadn't sold yet. Wasn't even under contract yet. But they wanted to go ahead and start looking at another house. And so I showed them a few houses. They found one they absolutely fell in love with. They wanted that house. The problem is they could not afford to make 2 house payments. They couldn't afford to buy this house until their other house sold. But the other concern they had, that if they waited or tried to wait for their other house to sell, they were afraid that somebody else would buy the house they really wanted, and they probably would have lost that house for sure. So they actually talked to a lender here in town about this wraparound mortgage. Y'all, they did get approved for it. Now, I will tell you, y'all, this is a very risky loan for the lender. Very risky for the lender. So I promise you, y'all, if you have less than excellent credit, you need not look for this. Y'all, I'm telling you, this is a risky loan just all by itself. Y'all, if you create any more risk because of a bad credit score or too much other debt, y'all, whatever the case may be, chances of you getting this loan is almost zero. Okay? So you got to be in good financial standing just to get this loan. But the way it works is this. Y'all, they were approved, and this is the way it basically worked. They said, we'll go ahead and loan you the money you need to buy the new house. But they're not going to have to make two different house payments. Y'all, they only have to make one payment to the new lender here. And then the lender here in town would now make the payment for them on their house in the neighboring county. So they're only making the one payment, and then the bank will make the payment for the house they're trying to sell until it actually sells. Now, once it sells, then we don't have to do that anymore, and all the payments go back to what it would normally be. Now, obviously, because they're only making one payment, y'all, that payment they're making was a little bit more than what it would be if it was just on the house they were just buying. But because it was basically for two different houses, y'all, they had to pay a little bit more. Y'all, it was a whole lot less than making two completely different mortgage payments. But they were only paying one, a little bit more than normal. But once their other house sold, then it dropped down to the normal payment, and they just went on about their normal business. But here's where you could run into issues with this wraparound. And by the way, that's why they call it a wraparound. In essence, you have two loans wrapped into one. You're making one payment on the two loans wrapped together. Okay? Now, y'all, in your material in your book, y'all, I believe it's the second paragraph under wraparound mortgage. Make sure you understand that second paragraph. Y'all, that is testable material right there. Now, I'm going to go ahead and explain it real quick. I'm going to tell you basically what it's saying, so there's no misunderstandings. But, y'all, oftentimes, in fact, probably more times than not, y'all, when you sign a mortgage, y'all, to get a loan from, to buy a house, oftentimes they will have in the mortgage something they call a due on sale clause. Now, y'all, we're going to actually talk more about that provision or clause here in a little bit. But for now, y'all, basically what that provision in the mortgage or clause states or requires is this. As long as you own this house, or own this property, nobody else can make payments on your behalf. If you allow anybody else to make payments on your behalf, we're going to demand the full balance be paid at once, right now. And if you can't pay it, we're going to take the house from you. Y'all, that's what they call due on sale. Y'all, what they're trying, I think the primary reason for this clause is, y'all, they don't want you to basically sell your house to somebody else and hope that those people are going to make the payments for you. Y'all, the bank will have no part of that. That nobody else can make payments on your behalf if that clause is in that first underlying mortgage. Well, if that clause is in fact in your mortgage, then a wraparound is not going to work. Y'all, you can't do a wraparound mortgage with that provision in that first mortgage on the property next door or in the county next door, right? Y'all, because of that provision. And you said, well, wait a minute, it's another bank making the payment. Y'all, it doesn't matter. Y'all, the provision says nobody else can make payments on your behalf. So if you've got another bank making the payments, y'all, that's a violation of the due on sale clause, and the other bank can demand full payment up front right now, and then you're going to have a problem, right? You're going to have all kind of issues. So what do I need to understand, or what do I need to know here? Y'all, a question they will probably ask in some fashion. If there is a due on sale clause in the first underlying mortgage, i.e. the one in the county next door, then which of the following loans would not be an option? And obviously they're looking for the wraparound mortgage. That's it. Okie dokie. That's good stuff right there. Y'all, the next loan is a sale and lease back. And that's exactly what it sounds like. Y'all, this is where you can actually sell your property to somebody else and then turn right around and lease it back from them. So in essence, you're no longer the owner of the property, you're now the tenant in the property. Y'all, it's just called a sale and lease back. Y'all, those are actually fairly common, quite frankly. Y'all, they're used for all kind of reasons, and we're not going to get into all why. Y'all, if it's something you're interested in, you can certainly look at it, but y'all, it's exactly what it sounds, what it sounds like. Y'all, you sell it and then lease it right back from the person you sold it to. Then you see the negative amortization. And I guess the key term here is negative. Y'all, this is a very negative loan. For one, it's just an interest-only loan. So the payments you make are just interest only. Y'all, you're not paying down any principal. Y'all, you're not paying principal. You're not paying down what you actually owe. You're just paying interest. The problem here is because it's a negative amortization, you're not even paying all the interest you owe. So it's basically a partial interest payment. No principal, partial interest. So if you think about it, y'all, every day you have this loan, the amount you owe to pay it off is getting higher and higher and higher and higher. Because the interest is compounding. Y'all, it's getting higher and higher because you're not making a full interest payment. So, y'all, I'm sure there'll be a good reason to need or want a loan like this, but I can't see why Frankie would need it. Nope, don't like that one at all. That's too negative for me. All right. And then there's the construction loan. Now, y'all, these are very common right now today. Y'all, there's a shortage of housing nationwide, quite frankly. Y'all, as of this recording video, y'all, we have a nationwide short. Y'all, people aren't selling their home. Y'all, because interest rates have gotten higher. Y'all, they're sitting in a home right now paying 2.5%, 3% interest. Well, y'all, who wants to sell their home and they're only having to pay 2.5%, 3% interest to move into another home, and now they're paying 7.5% interest? Y'all, so nobody's doing that right now. I say nobody. Y'all, some are, praise God. But y'all, very few people are wanting to sell their home, and because of that, we've got a shortage of houses for sale. Well, when that happens, now what are you going to do? You can't buy one that's sitting there. Then y'all, you're going to have to build. Excuse me. So now we're going to have to build a house. Thus, you might need a construction loan in order to do that. Well, how does a construction loan work? Well, y'all, this is actually a pretty good loan, to get the house built. But the way it works is that, now, first of all, this is another somewhat risky loan, again, for the lender, okay? Because I will also take, y'all, not only does the borrower have to qualify, y'all, like any other loan, you got to qualify for the loan, but who else would have to qualify for this? Y'all, the builder. The builder also must qualify. So whoever you select as a builder, again, better be in good financial standing, or you ain't getting a construction loan, okay? But basically the way it works is this. Y'all, let's say you need $200,000 to build the house. You get approved, and basically, now first of all, when you get approved, the bank's not going to give you $200,000 and say go ahead and build the house. That ain't the way it's going to work. In fact, they're probably not going to give you none of it, you being the borrower. Rather, what they might do is they might give, say, 20% of the loan amount to the builder. Here's 20% of it, builder. Start building. Now, once you've built 20% of the house, then you need to let us know. We'll send our building inspector out to check the work, make sure you have, in fact, completed 20% of the work. And assuming you have, then we'll give you another check for another 20%. Y'all, we just keep doing this until the house is completely built. Now, here's the advantage to the borrower. One, it's a very cheap loan, y'all, relatively speaking, okay? But y'all, it's a pretty cheap loan to get the house built, because basically it's just an interest-only loan. So the payment you're making every month is going to be very cheap, okay? Because, y'all, again, it's just interest only while you're building the house. And the other nice thing about it, y'all, you're not paying the interest on the full amount of the loan from start to finish. Okay, y'all. So when they paid out that first 20% of the loan amount to the builder, then that's what you're making interest payments on. So y'all, that's going to be a very small interest payment. But now once they pay out another 20%, now that's 40% of the loan, but now you're paying interest on the 40%. So what I want you to see here, y'all, you're only making interest payments on the amount of money that's already been paid out to the builder, okay? So it's not like you're paying interest on the full $200,000 from start to finish. So it's a very cheap loan to get the house built. Now, once it's built, y'all, and the builder provides that certificate of occupancy, we're done. Then, y'all, the construction loan will then convert or roll over into some other type loan, whether it be conventional or FHA, y'all, whatever the case may be. Y'all, this is stuff that you will agree to up front, okay? It's not something you'll be deciding at the last minute. But then once it converts over to whatever other loan that has been agreed upon, then you start making your normal payments, y'all, an amortized payment of both principal and interest for however long you decided to amortize that loan. So, y'all, it's a pretty good loan, cheap loan, just to get the house built. Pretty good. All right, that's the construction. Y'all, now we look at a couple types of loans that really are dealing with property being pledged. Y'all, two types of loans here. And I would caution you that, y'all, where you want to be careful here is you don't get these two loans confused. Y'all, the package mortgage and a blanket mortgage. Y'all, that's a problem we see on the test a lot. Y'all, we get them backwards, get them confused. So don't do that. Well, the first one here is this package mortgage loan. Y'all, this is a loan that you could get if you're financing both real and personal property all together. You're financing it all together. Well, what does that mean? Well, y'all, if you remember back in the real property chapter, I think it's chapter 3 or so, but anyway, y'all remember we talked about the difference between real property versus personal property. And typically with most mortgages, y'all, you cannot finance personal property into the deal. Y'all, it's only for real property, y'all, land, house, and so forth. But this is a loan where you can finance both the real and personal property together. Y'all, you see this where you tend to see it a lot, or most often, I guess, is like with new condominiums. Y'all, brand new condos. Y'all, oftentimes you can buy the condominium and it comes fully furnished. They've already got furniture in it. all the appliances, all the furniture, everything you're going to need. All you got to do is just move in. Well, obviously all that furniture is considered personal property. The only way you're going to be able to finance both the personal and real property is to get a package mortgage. That's the only time you're allowed to finance the two together. Package mortgage. But then there's a blanket mortgage. Excuse me again. Well, the blanket mortgage, let's make sure we understand a few things here before I even try to explain this to you. If you borrow money from the bank, that mortgage, when you sign the mortgage, becomes a lien, right? The lien means it is also considered an encumbrance. We talked about this earlier. And as long as that lien or encumbrance is in place, can you sell that property or any part of the property? No. All liens, all encumbrances have to be removed, because as long as there's an encumbrance, we know that an encumbrance renders the property unmarketable. So you cannot sell or convey the property or any part of the property until or unless all encumbrances have been removed. That includes a mortgage lien. Well, now keep that in mind with what the example I'm about to give you. So say I'm a developer and I'm looking at buying this 100 acres of land. It's a 100-acre tract of land that obviously my intentions are to develop, subdivide it into lots and blocks, and then sell off individual lots to individuals. Well, if I go borrow money to buy this 100-acre tract of land, now there's a lien on that tract of land. Can I sell off individual lots? No, not as long as that lien is there, because that's an encumbrance. You can't do that. But here's kind of a workaround, if you will, and it's called a blanket mortgage. And again, this is something you've got to tell the lender you got to make sure the lender knows what you're doing to make sure all this is set up properly. But basically, you're asking for a blanket mortgage. And with the blanket mortgage, the way it's going to work is this: they will agree to allow you to sell off individual lots, even though the lien is there. But part of the deal would be that for each lot you sell, some agreed upon percentage of that sales price has to be paid directly back to the lender. So in other words, you can't keep all of it. You can't keep all the sales price. Some percentage, again, whatever you and that bank agreed to, must be paid back to the bank. And obviously that goes towards paying off what you owe for buying the property to begin with. But that's a blanket mortgage. All right. So be careful with that one for sure. And then there's a couple other different sources of money here. One's we call installment land contract. Then you see another one called a purchase money mortgage. Both of these it's just owner financing. That's it. Installment land contract is just owner financing. You buy the property and the owners agree that you can just make payments directly to them, so you don't have to go to the bank. Same thing with a purchase money mortgage. You can buy the property and just make your payments directly to the seller. Again, owner financing. Well then, Frankie, why do we need two different names if they're the same thing? Well, they are the same thing, but they work differently. If the buyer and the seller agree to the installment land contract, then at least while the payments are being made, the seller is going to keep title to the property. So in other words, I might be saying, buyer, I'll sell it to you and you just pay me, but I'm keeping the title until you pay every dime you owe me. Once you pay me in full, then I'll convey the title to you. But if we agree to do a purchase money mortgage, Now the sellers agreed to actually convey title to the property to the buyer at closing. So now the buyer owns title to the property while they're making payments to the seller. Yeah, that's a pretty big deal there. But really, that's the only difference between these two types of loans. Who's going to get or keep title to the property? Now, one thing I will also want to bring to your attention here, y'all, that first one, installment land contract, y'all, on the exam, y'all, they may refer to this type loan in two or maybe possibly three different ways. Y'all, it's all the same loan. But y'all, they may call it an installment land contract. Y'all, sometimes they may just refer to it as an installment contract. But oftentimes, and very common, they'll just call it a land contract. Y'all, you hear that term used a lot. Land contract. Y'all, why they use the terms interchangeable like that, again, I don't know. The only thing I can think of is to cause you problems on the state exam. But y'all, what I want you to be aware of is, y'all, they may not call it installment land contract or use that term in the question. They may just call it a land contract or potentially an installment contract. Just don't let that confuse you. Don't let that throw you off. It's still the same installment land contract. It's just owner financing. And in that case, the seller keeps title to the property until the loan is paid in full.